The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Friday, the 26th of February, 2021. On the podcast today, Paul Hill, full-time investor and equity analyst, gives his view on the market and what stocks he's been buying and holding, and also talks about other stocks as well, including Ilika, Avacta, Oncimmune, Equals, Escape Hunt, Grainger on the market, Practice Holdings, Lloyds and Aviva. Also on the podcast, Russ Mould, investment director at stockbroker AJ Bell, talks about the market wobble and whether it's down to inflation and bond yields. Also, Vadim Alexandre, head of healthcare at SP Angel, discusses Shield, Therapeutics and Diurnal. Plus, as always, I have two lists for you, the top 5 most followed companies on Vox Markets in the last 24 hours, and the top 5 most liked and most read RNSs too. You can check that out at voxmarkets.co.uk. We'll see lots of other content there. In fact, there's one there from Ectech signs land deal for Billingham Waste Gasification and Power Project. There's also a Shield Therapeutics article, one there on Silence Therapeutics, one there on Escape Hunt's confident that both consumer and corporate demand will return strongly. Check that out there. And also, don't worry, our COVID-19 index. Biggest rise of the day is Dev Clever Holdings, up to 29 pence, 7.4% up. Biggest faller, Chromet Group down 8.2% to 17.35 pence. Check that out at voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now, and in super technicolor with a white background, their big smile, it's Paul Hill, full-time smiler, full-time equity analyst, and full-time investor. He's full-time, all the time, full-time. Paul Hill. You all right, fella?
Well, thanks for the introduction. Morning, Justin.
Yeah, but you know what? The markets are always interesting. I always say this, to everyone. Get involved with it. It's funny how more people are coming to the market just because they've, been spending more time at home trying to find things to do. And Robinhood has blown up in the US, and it's more traffic over here. I know it's Vox. We had a weekly meeting. The traffic to Vox market has gone up massively. So it's good to see more people getting involved. I hope they don't go crazy and go into sort of super risky stocks at the start and blow their accounts up, because that's not the way to start. It's not bad to have a bit of a loser though when you first start. Having a big win at the start can be dangerous, can't it? Because then you think, this is easy, and I mortgage my house and put it on the next term.
You made a great point. I'm actually a bit concerned because there's been so many people from the Robinhood brigade and also with Reddit and these day traders and stuff, because they've never really invested at all, but they've been locked down, and as of March they've had a one-way bet because the markets have just gone vertical. They've made a shed load of money. They think it's easy, and all you need is a wobble. And you could get a few of them because what it does, it lulls you into a full sense of security. If you make a lot of money quite quickly and straight away, then the danger is you become a bit sort of like complacent and maybe a touch arrogant. And if you do that, then you'll make some big mistakes because you end up then sort of like you're not managing your risk profile. And what happens is that you get you decide then, right, okay, I'm good with these single stocks, and I've put about, I've put half my salary in and done really well. I've made say $500,000, and then all of a sudden you decide to put $500,000 on, I don't know, GameStop at $500, and then it all comes horribly wrong and it unwinds. So I'm with you. You just got to be careful, because if you're very new to this game, then the markets can change very quickly and do weird things. And the one thing that upsets a lot of people, including me, and probably even you, Justin, you're a cool cookie, is that when you get these black swan events, unknown unknowns, i.e. stuff that really goes, it's got tail risk probabilities. But these things happen, and we got a shed load of them last year, and we're going to get plenty going forward. And when you have things in the markets that do things that are very, very unusual, let's be clear about it, even the really smart professional traders get caught out. We had Nick Leeson back in the 80s when I was, when you and I were around, who blew up bearings. We had Jerome Carovial who took down SocGen, and then we had the head of the chief investment officer of JP Morgan, the London Whale. I think he lost $6 billion. So
look at Neil Woodford. Let's be honest, he was a good fund manager, but he stepped outside his comfort zone and into small, sort of risky liquid stocks. And all of a sudden, people started, selling. He didn't know what to do with this. Stocks went down, and then selling begets selling. That's the trouble. And when everyone starts running for the door, that's when it starts to get panicky. And that happened back in March. Everyone started running for the door at the same time. And luckily, I think I was nowhere near fully invested, but it was a bit scary because it's so quick, that sell-off. And for any newbies in the market, I think most of the newbies have come in since then. And like I say, it's largely been a one-way bet. Any stock you look at, post that March sell-off, you could have doubled in. Big stocks, small stocks, and more than that. So you've got these guys. So it's very easy, very easy. When you think it's, you can't lose. And like you say, you back up the truck and you take on leverage and you borrow some money. And you say, listen, guys, honestly, get your friends involved and your family involved, get your brother-in-law involved. Listen, it's a one-way thing. And they all chuck it in. And like you said, that saying, everyone is in one side of the boat. Yeah. The inevitable happens. So you've always got to have a bit of an eye on the risk and stuff, and be a bit careful. So
you've had a wobble on some of the high octane stuff out in Nasdaq in the last few days, and I mean it's come down 5 or 10%. Things like your Teslas, your Snowflakes, and these kind of guys. But the big point for long-term investors, the point to remember is this is actually happening with a strengthening economy. The Nasdaq's gone down on a strengthening economy. It's not on a weakening economy. And all that is just multiple compression. So if you're in sort of like more value orientated stocks, then you've probably done okay. I mean, my portfolio has been totally flat. In fact, it's like gone up slightly. But it's really sort of like these high octane stuffs that get bid up and bid down, high volatility. And I think you've banged the table many a time. You need diversification. You need basically some of them are good steady eddies, but all equally you need something to be able to sort of like give you a bit of alpha, which is some of your stocks. You can't have, you can, but you've got to take, if you're going to have everything of all the same type, if you're going to have a Zooms kind of stock and have 12 of them in your portfolio and there's only those type of stocks, then you've got to expect it's going to go up quick and it's going to go down quick and you're going to have huge amounts of daily change, because that's what happens.
Yeah, I mean, I looked today. 1, 2, 3, 4, 5, 6, 7, 8. I got 8 stocks. I had to count. I thought it was 9, but no, it was 8. And I got 2 risers, 2 non-movers, and 4 falling a little bit. The biggest fall was like 5.5%, pretty much. That's Ilika, but it doesn't matter. It's balanced up because my top riser is up so over 8%. So, and the other one's up over 3%. So it's not much movement in the portfolio now. If I just own the one Ilika hot stock, EV stock that I see is going to power ahead, and I had all my money in that. And that'd be quite worrying because it's dropped a couple of times in the last few days, and it's come off with Tesla and all that as well. It's following that sort of trend. So that'd be quite worrying. But because I've got other stocks in there, it's fine. So largely half of my portfolio is flat or up, so it's fine. So and you got
I mean, we might as well just touched on it. Ilika, etc. I mean, they had an update, didn't they, on one of their manufacturing facilities? Yeah,
so they've got 2 sectors about it. Everyone's excited for the Goliath batteries. These are the big batteries for EV. They're a couple of years off yet. But there's lots of articles. In fact, I tweeted one a day saying that the future for EV is solid state because they can hold charge 5 times as longer. They're not as dangerous as far as they don't blow up. They haven't got sort of that liquid sort of stuff inside them. They're also fast charging, so range anxiety is no problem either. All that stuff. So, but yeah, they've got this. But they've also got Styriax, which is small med tech devices. These are tiny solid state batteries you can put in these medical devices. They can self charge for years and years. And so you put them in the body or something, they'll stay there for years, or in extreme temperatures,
or something like that.
Yeah, or extreme temperatures in climates. So you put using there as well. They don't have to be. There's very low maintenance levels on them. Once you put them in there, they stay there for years, and they're very efficient. So that's what they're doing. They're manufacturing that. They're bringing this manufacturing sort of plant up to speed, and by the time it's up to speed, it'll be 70 times increase in the production capacity. So that'll be second half of this year. It'll be sort of built, and then they'll start producing pretty much next year. They did say I don't know why they say this. The company's been made aware that some construction material suppliers are experiencing supply chain delays, particularly from Europe, which the company is managing in order to minimise any impact. They do not believe this will have any fundamental impact. Why do they say it then? It's like, it doesn't have any impact. Why flag up a negative? But it's not going to affect us. Just but I just think, it's going in the right direction. What I like about that, one of the reasons why I interviewed these guys, why I invested in these guys, is that they did say after the last fundraise, they've got a roadmap to build this first production of Steriax, and it goes into Goliath. But they will, so this cash fundraise will take them to cash flow positive. And I think I quite like that. That's that kind of planning that far off. And so if they do another fundraise now, I'll kick up holy hell saying, hang on a sec, you put that in your presentations, in your final reports, everything. You can't say that and change your mind now. Yeah. But so I like the fact that they've got that sort of foresight, that, sight through to cash flow positive. And regardless of where it goes, it is very volatile, but I'm just thinking 5 years on the road, these are one of the most advanced guys. Well, in the UK, they are the most advanced in solid state batteries. So I just think it's a good company to be in for like 3 to 5, 10 years down the line. So,
I think
I'll hold on.
I would agree. As long as you sort of like look at the long term and then you don't mind the sort of short term volatility. I mean, another company that has got breakthrough technology, which I actually spoke to Alistair Smith yesterday, is Avacta. And what I hadn't appreciated, I mean, I was a bit embarrassed really to a certain extent because I've been a professional investor for 30 odd years and I hadn't really sort of fully grasped the sort of the scale and the opportunity and the flexibility of their two sort of breakthrough platforms. I mean, they've got the Afima platform and they've got the Precision platform, and both of them are addressing enormous, absolutely gigantic markets, sort of, multi-billions, And then you've got basically their Precision platform, which does effectively delivers chemotherapy into tumours, and that's going sort of phase 3 trials and stuff. Sorry, phase 1 trials, and that improves the safety profile of the chemotherapy drug they've got, which is doxorubicin, and what I hadn't realised as well with chemotherapy, it actually is pretty effective in actually reducing the size of tumours. But the problem is it's got a toxicity, and effectively what the pro drug does, and using this Precision platform, is it improves the safety profile. So it effectively could, if it's successful, rejuvenate the whole of the chemotherapy drugs, because it still is a workhorse around the world, chemotherapy. And it's a $50 billion business, so that's one of them. But the thing which obviously you and I and everybody else has been sort of like talking about is the rapid lateral flow testing, which is obviously for COVID, because they came out with some blockbuster accuracy or more accurate lateral flow tests in a clinical environment about 2 weeks ago. And it's 97% sensitive and about 100% specificity as well. So absolutely perfectly balanced and very high on the accuracy. But what I haven't appreciated with using the Afima platform, and this is why, you've probably heard yourself, lateral flow tests when you've got, kids at school and stuff like that, they're not very accurate. And the reason why they're not very accurate is because 50% of people 50% of infections occur from people who are pre-symptomatic, and it just doesn't pick those up. But what this does, which is absolutely brilliant, and I hadn't appreciated, these Afimas effectively attach to the spike protein of the COVID, and effectively what it's doing is amplifying the existence of COVID. And therefore, putting like a big flag on top of COVID, and therefore you get this huge improvement in accuracy because it's much easier to see. It's like shining a light onto COVID, and that's why the accuracy is good. And we're talking of a test here in 20 minutes. I mean, it could be an absolute game changer. I mean, do you know what? I don't know if you follow on Twitter, Miles McNulty. It's worth following. Yeah, no, I should do that. I agree.
Because Miles is all over Avacta, and he's been over them for a long time before the test came out, and of course that's been a bonus to the share price and everything. But yeah, I think he's an ex-analyst, so he
knows his onions,
goes into his stuff, and he's very data-driven. He does a lot of stuff. But if you look on his Twitter feed, you can't be more researched than him. Fair play, he's banged the drum there. I mean, do you know what? I was doing a video. I launched my website, pre-launch for Share Pickers, and it's for everyone really. But it's also I'm populating a learning section at the moment, and I talk about risk and reward, and one of the risks, I said, if you're new to the market, if I were you, I'd avoid this kind of, and I talk about the risks and overexposure, but also certain sectors. And I said one of them is oil and gas, wildcat drills for oil. It's ridiculous. It's a gamble. The odds aren't in your favour at all. From the best you can get for wildcat drills is 3-1, and they've probably got 10-1. That's gambling on a horse. So with investing, you should be odds on, on your favour. And another one actually was if you start investing preclinical phase on pharma companies, especially oncology. It's only a 14% chance that they get through to actual commerciality. So I said, you've got to be careful there. I mean, if you get a bit later...
But one thing about Avacta, is the drug they're actually using, the chemotherapy, doxorubicin, is absolutely well known. It's been used for 40 years. So
you've got to be. I'm saying, you've got to be specific to each company. But what I'm saying is, if you're going to go for either oil or gas, because a lot of people on Twitter do the same kind of, they're in those high risk plays. So if you're going for oil or gas or pharma, go for pharma, because if they do get a successful drug, it does go to the moon generally. With oil and gas, you have discovery, and this is massive. You don't even get three or four times your money generally on oil and gas discoveries because it's been going down. So I said, if you're going to play the two, go for the pharma, but you have to know your stuff because it's very complex. And if you want to get in, and you reduce your odds greatly by joining in after phase 1 or phase 2, because but then the share price has gone up a little bit then as well. But that's the problem.
Genuinely, I think this, because the opportunities are just massive. We're just talking huge $1 billion market.
Yeah, but cancer's the biggest, most spent
just
on that.
One of these, exactly, just one of these opportunities land and they've got a whole basket of them. Just one of them land. Then it's gone already. The shares have already multiplied by 4, 5, 6 times, etc. You could probably see it doing that again without any problem whatsoever. Simply because if you look at things like Novavax, it's a $20 billion business. If you look at sort of like Exact Science, it's $23 billion. If you look at sort of like BioNTech, nobody even heard of that, and that's $27 billion. So it's got huge amounts of runway ahead of it.
Have you heard of Arix Bioscience? I mean, I've been on the podcast a few times. They're an investor, big in all these sort of cutting edge, oncology areas. And they've had some of their investee companies had a massive success recently in phase, and they jumped. In fact, have a look at them, research into them. If you want to sort of more a safe play, they're an investment company, and they all do cutting edge bio, and they're big investors as well. But it's Arix is the ticker, but it's worth looking at.
Yeah, just on that healthcare. I mean, you interviewed, I think it was Adam Hill, didn't you, of Oncimmune a couple of weeks back or something. I haven't actually listened to it. I should do, but I did actually catch their interims, and it's sort of like business as usual. They're making good progress on that Immuno Insights platform with the likes of Roche and Genentech and signing good contracts. And I see the shares have moved up because, effectively people are starting to recognise, again, this is breakthrough technology. And, if you look at sort of multiples that people have been bought for these type of businesses, and you look at Illumina, they bought Grail for $8 billion. And then you look at, there was another one which went for about $2 billion. But if you use the same multiples for Oncimmune, you get £3.50 or £4.
I'll share the screen. In fact, can you? I can't share the screen with you. It's disabled, I think, from your end. But the share price has done very well. It's gone from 40 pence back in March last year. Because if you do anything, but now it's £2.10. That's nice. And 40 pence, £2. That's a nice return, isn't it?
Well, no, the market. I mean, basically, the management team are doing a great job there because that Immuno Insights platform is absolutely world leading. I mean, it's a huge database that's increasing in depth and value by the day because it's increasing in samples, and you can't replicate these because it's just like taking data and samples for years and years and years. So it's got. It's one
of those things I didn't really. I mean, I understand it's a good thing and it's very they've got something there, but it's one of those things I don't really understand, And I'm thinking, right, I understand some of the platform. Yeah, okay. It seems like you've got these big names signing up with you and using it and all that stuff, so it must be spot on. But I don't really get it. It's one of the
there's two things. The world's biggest diagnostics company, Roche, is one of their lead customers, which basically says if they can't do it, it's got to be pretty unique, okay?
Yeah.
But what immunodiagnostics is, and this is their bread and butter, okay? It creates effectively flags to be able to say, has your body got a condition, whether that's an infectious disease, an autoimmune condition, before you know about it, and it may be cancer as well, etc. Because effectively what your immune system is doing all the time, and we're doing it now for you, is that it's fighting infection, it's fighting antigens, but you don't generally see it, you don't suffer from it, you just get up a day and do your sort of thing. But using autoimmune diagnostics, you can bring forward the diagnosis of that individual with a condition by years. Because normally what happens is that people rock up into hospital throwing up blood and they've got metastatic cancer or something, advanced cancer that is, and they can't recover. They've got a lifespan of like 6 months because they didn't know they had it. They have a huge lump or whatever it is. These guys with their immunodiagnostics for lots of conditions, autoimmune, infectious diseases, cancer, all this sort of stuff, by using effectively a panel of flags, it's almost like the Aviva, the Aviva platform, because effectively what you're doing is you're telling people early what condition they've got before they know about it, and therefore you can treat it. You catch something early, you can treat it, but if you catch something late, you're absolutely stuffed. That's why so many people die of cancer, because not many people know about it. It's far too late.
Yeah, exactly. Do you know, and like you see, when you look at the company there, what they're 130 million market cap. The revenues are small, but they're growing quickly from a small base. But like I said, that area, that early detection of cancer is massive. I don't know how it works, but it's very impressive. And just on a general note, when you tend to get a market leader or big company, a well-known company, sign up with a small company, it's always a good sign, always a positive sign. Even in the mining space, if you get big guys coming to start looking at the smaller thing, because they've got a field of people who can look into these guys. They're all highly accredited.
Another example of that, and I own shares in it. It's been quite interesting actually. They've picked up is Equals Group, okay? Yeah, and they do basically B2B e-payments, okay? And just when it comes to endorsements, they've got one B2B2B customer, a small little customer called MasterCard, who decide to use their platform because they can't do it. I mean, what does that say? It says they've got something in there, isn't it? Because these guys, they're not stupid. They spend so much. So I'm absolutely with you, Justin. If you've got a sort of like a small company that's got, I mean, it's like your Ilika. I don't know who the one it's Jaguar, I think it is, isn't it, or something like that? With a
Jaguar and Jaguar on one side that's for high performance. There's also, I think it's Honda on one part, and and also McLaren as well. They're working with which means one, they've got great technology, but more importantly, that small company then can use it as a huge reference site to go and sell somewhere else, because they just say you get that sort of halo effect. Yeah, well, exactly. Anything you get big companies hooking up with, big and well-known companies hooking up with a small unknown, it's always a good sign. Yeah. And I'm going to bang the drum here, but if you look at, when I first look at escape rooms, for example, and they're all, we have one on the road here, and it was like independent, it's okay. And then you look at some escape hunt, you realise the BBC hooked up with them with Doctor Who. Now, Doctor Who, that's a premier brand for BBC. It's millions of followers around the world for Doctor Who. Yeah. So for them to trust Escape Hunt with that brand to come up with a theme, you've got to understand Escape Hunt, the branding wise, are premium. They're not going to trust it with anyone, because Netflix did the same with one of their series. But again, those kind of associations with bigger brands and bigger companies are always good in sign as to how good a quality smaller company is, or what they've got is quite good. And I said on Twitter, they just announced a trading update and the acquisition of their French.
Yeah, how are they doing, old Escape Hunt?
Well, do you know what? I said it. This is the only leisure company I know that's expanding and improving operationally, because they're literally their EBITDA loss went down and from the previous year, which is to be expected. But I mean, the cash has gone up. The amount of sites they've gone up has gone up by 89%. And I just think I can't wait for the economy to open back up now, because there's demand there beforehand, and it'll come back. And I think domestic demand for anything, leisure, hospitality, from restaurants, everything will go up, because we can't travel at the moment because our vaccination program is so, unless you travel to Israel maybe, but our vaccination program is so good, so advanced, that there's not many countries in the world that's keeping up with us. So we're scared of bringing other people into the country with infection rates.
And they're purchasing their sites, aren't they? Looking for some sites which are really sort of like getting some good value deals.
Yeah. Well, and that's it. At the moment, you said, you've got these commercial landlords taking 30% rent, if that, and most people are just leaving. All these shops that don't have a big online presence are leaving. If they do have a big online presence, they realise, hang on a sec. Even Asda, recently just said, didn't they? They're going to lay off maybe 5,000 people because online shopping's gone massive. So you've got all these units in these big sort of centre of town sort of places that are going to leaving. So they are now negotiating non-stop with these places all around the country looking for new venues. But it'll bounce back, Joe. I don't think it'll go back, like I said, office space wise. I don't think it'll go back 100% like it was before, but people will still go to the office, maybe be a 60-40 split or whatever, 50-50 or whatever, but people still go back and town centres will not die, but it'll be a change, I think.
You and I are on the same page. I mean, actually, what I think will happen is that, yes, there won't be as many people going into the offices, but actually you'll still get quite a few people who want to live in the cities, urbanisation, because, I mean, Mike, one of my daughters who's been staying here during the lockdown, I mean, she's renting, but effectively living here during the period. But she'll go straight back because she wants the nightclubs, she wants the actual social life, she wants the restaurants and all that kind of stuff. She may not be working in the office 5 days a week, but she'll still be living there. And what's quite interesting is that I've actually made, on the same basis as that logic, a little purchase this week as well in the UK's biggest listed private rental landlord called Grainger. And they've got about 9,000 sort of like 1-2 bedroom, flats and apartments, and they've got small houses as well and stuff like that they rent out. And it's basically this is not the kind of stock that you buy, but it's basically it's like a inflation linked bond proxy defensive trading at a 15% discount to net tangible assets. And the reason why I've bought it is basically because of, for inflation wise, and it's been hit because what part of their occupancy is in city centres, and it's gone down to 90% from like 100%. But I still think they serve young professionals. I still think people are going to go back in. And what you've also got is the private rental sector. You've got a lot of sort of mom and pop owners, one person who is a landlord, except one site landlords, and they're leaving the market. I mean, that they used to have 20% of the market 10 years ago. They've got 9% of it now, and it's been replaced by professionals as the market's become more regulated and living standards. So for all of the Grainger sites, they've got broadbands, they've got communal areas for people and all that kind of stuff. So anyway, it was just quite interesting because you independently were talking about people going back into the city centres to have entertainment. I think they'll go back. I think there'll be a few of them, quite a lot of them, who will actually want to live there and enjoy themselves, because a lot of people have come out into the sticks and got bored, and then they want to go back into the sort of like that nightlife, that buzz. They may not work as much.
Listen, young people are hardwired to do that. That's how the human population exists. They procreate. Exactly. That's what we're meant to do. And when you're young, you're hardwired to want to socialize and go out and find your partner. And that's what you're meant to do. So it's all us middle-aged people criticizing young people to want to party and can court down. They're hardwired to do that. They're meant to socialize. If they didn't, the human race would die out. So it's going against that trait, that need to want to do that. It's hard.
I bet you still party hard though, don't you?
No, I do. Look at it. What time do you go to bed? Because I get quite early, and genuinely, I think weekends I probably stay up. I'm watching something late, maybe a boxing match or something. I may stay up late, but generally, even the weekends I'm in bed before 11. I think.
Yeah, I know. Yeah. No, well, I was.
Weekdays is like it's 8 o'clock, 9 o'clock. I'm reading a book. That's me.
Yeah. Well, what time did you go to bed last night?
Last night, same time. I get in bed about, put the kids to bed, they're 8:30, and I'm reading about 8:30, 9:30, and I'm sleeping by 10,
Oh,
because of this. I love getting in the morning, get my stuff done, and I want to see what news is coming out in the stock market. That's what I'm more incentivized by that now than staying up late. As you get older, you realize it's the mornings is where it's at, not the nights.
I'm only asking because I was actually up this morning at 11:15 last night. But I'm like you. When you get into the markets, you get earlier and earlier and earlier.
Yeah, exactly. So what time do you normally go to bed then?
I was tired, so I went to bed about, 7:30, but I just couldn't sleep very well, so I sort of like got up about 11:15. I've been working all the way through the night.
I didn't realise that you worked all the way through. Wow.
Yeah. No, I've been working all night. Yeah, I've already done a big day. Yeah. No, this is like 7:00 in the evening.
Yeah. Talk about new buys, right? I bought a new stock. I'm not going to tell you about it.
Oh, okay. Large.
But my members can see it on my website, sharepickers.com.
Okay, right.
No, because what I'm doing, the thing is, my thing is small cap stocks, and I search a company and I share it, and because it's very liquid, a lot of people jump on it. The share price goes nuts, and then it maybe gets some sellers, and it gets very volatile. And so what I want to do is shut it down, let people research it, and I want to calmly talk about it. But I won't talk about it yet. But I like it. It's in sort of fintech, but in fact, talking about big companies, talking about the smaller companies, they've got that going on, and so it's very exciting. There's a contract happening there, but I will announce it in about a couple of weeks. But unless you remember,
what's the portfolio split? The sort of sector split and construction. I mean, is it all small?
So all small caps, yeah.
Right, okay,
I just find those quite exciting, though. And in fact, it's like it took me. I had to go out of my. I just mess around it. I said my area of semi-competence. I had to go out of that area doing the dash for cash to understand what I really liked, and I just jumped back in there. I messed around with some bigger stocks, and I don't really like them that much. And so I think you can get diversity in small companies. My portfolio, even though they're more volatile, it's just not that hugely volatile. As long as there are 8 stocks, fine. So I got med tech, I got EV sort of tech, so gaming, esports, like I said, leisure. I got fintech. Cybercrime on the market actually is a retail sort of property portal. So in fact, I quite like the update. They came out with an update. Revenue up 20% right, from last year to 23 million. And that's including they get a lot of discounts to customers during COVID and lockdown, all that stuff. So during a year where there's lots of disruption, people may have been viewing it online and stuff, but they still gave away a lot of discount. They still managed to generate 20% growth top line, and they went from something like a 9 million loss last year to 2.3 million profit. So I think it's very good. They said they're going to market more, so they may not continue that profit, but they still got 10 million in cash. I don't think they have to go back to the market. And they are getting traction. Jason Tebb, the new guy's in there, and he's saying we are developing products now that will deepen our relationship with estate agents. And one of them is very good. You click a button and said, value my property. You type in your postcode, and it suggests what for estate agents that give you a valuation, So that's very good. So I like that. And I think they are going to make,
the amount of leads they get for their clients is phenomenal, isn't it? I mean, we're talking millions a month, isn't it? I mean,
but do you know what? I think let me just look at the thing.
I think 2 million. I think they got sort of 1.8 million I saw or something like that. In January.
And in fact, and even compared to now, Rightmove is 70 times the valuation, of course, of on the market, and they say they're going to an average of for January 146 leads per advertiser. Right in that month, which is cracking for even advertising. You get 146 leads, and I've seen a lot of testimonials on Twitter saying they're also better quality than Rightmove for some reason, and so Rightmove only get about 170. So it's like it's not a huge difference, and is that worth 70 times? And Rightmove charge $1,000 per user at the moment. The average for on the market is 133 quid. I think they're aiming for 300 quid, which would boost the revenue massively. But yet it's almost an eighth of the amount they charge. So you can see why people are moving from Rightmove. As long as it's effective, and it seems to be is effective, why would you pay $1,000 when you can pay close to 300 quid for the same kind of results? So, and that's why estate agents own 65% of it as well. So that's there's a loyalty thing there. So I quite like it. I
agree. And I think the near-term opportunity is to convert the non-paying customers, isn't it, into paying ones. And if they do that, I think they can. What was the turnover? Was it? I had 23 down or something like 23.
Yeah, 23.
Yeah, I remember speaking to the CEO there about sort of 6 months ago, and he was giving me a sort of like, if they can manage to just convert their existing customers into paying, they get well over 40 mil. I mean, that's almost double where it is. And once you just get huge drop through on your profitability, then it just becomes another money machine, doesn't it?
Yeah. Exactly. They don't need to do a heck of a lot to achieve an uplift in the revenue. Like I say, I mean, initially they did introduce all these agents onto the free, pretty much, or an introductory fee, just to show them system, but now it's working. They say, well, we got to charge them now because where else are they going to get that value for money? Go back to Rightmove. And there's also a website of, I don't know if you saw that. Someone pointed out to me, there's a website, estate agents have set up a website which is anti-Rightmove. It's like encouraging everyone to come off it because they say they don't really care. They just take your money, and because they're a big dominant player, they can do that. Their customer
sounds like Reddit to me. That does having to go at all the hedge funds who are short GameStop.
I know. So
another one which is obviously sort of software or technology orientated that has had a pretty decent sort of like lockdown. Who came out with results was trading update was Proactis, and I mean they had just relatively flat revenues, only 3% down, but their EBITDA went up by 11%, and they've been having winning a whole bunch of series of contracts. And I know I mentioned last time, but they've managed and they've demonstrated that they're now been able to successfully replicate their UK and Dutch businesses overseas into France, Germany, and the US. And they just announced another B-paid contract as well. So the momentum's pretty good. Their top line growth in terms of new business wins has been strong, but hasn't yet fully been sort of like pushed into the sort of the revenues, and that's because they've had some legacy churn, which is now dropping away, and it's become really de minimis. And also, on the revenue side, it's been hit by because of the lockdown. You've had transactional revenues, which is sort of like artificially pushed it down. So once you get those two short-term issues falling away, which should be next year. I mean, I interviewed Tim Sykes, the CEO, and he's pretty confident that if they can continue replicating that model, they're going to hit easily double-digit top-line growth. And if you get that, you'll get a huge re-rating in the stock. They're currently trading at about 46, 47p. But if you put just a modest market multiple of 4 times sales on it, you get over 150p, which is actually not dissimilar to where the shares were trading only 2 years ago. So if you get that top-line organic growth, double digits, they're onto a winner because the margins are very good. And you get a lot of operating leverage and a lot of cash coming down to the bottom line. So I would alert people to have a look at that because that is a good recovery play, and that it's on that cusp. It's like you're on the market, i.e., such that it's been it's come through it, and it just is a matter of just carrying on that momentum of what you're currently doing well, and then you should see the fruits coming forward in the next sort of like 12 months.
Yeah, exactly. Yeah, exactly. That inflection point of where the marketing spend will not take them into huge loss-making territory on the market, and I suppose and because the revenues go up to a point where they can afford that, and so I'll tell you what I saw on the Vox website this week. It had Lloyds at number 1 followed company. Yeah, I saw that. So why was that then? They had their prelims. They had their prelims, and we've obviously talked about it quite a bit. And I've obviously Barclays there yesterday. They're now most followed. Barclays is there. Every now and again, you get Barclays or one of these big companies going in the top 10, 5 most followed. So. I was going to say how are the big boring stocks of Lloyds?
Exactly, you've dissed the big boys. And anyway, the banks. And the reason why I've been banging the table about Lloyds is that you've got a steepening yield curve. You've seen that in the US. You now started to see the UK. And because they make their money on the net interest margin, that will actually stabilise and hopefully get they'll be able to get them more money. But equally, what's happening is you're getting a steepening yield curve because the economy is getting stronger. And that means lower credit, or better credit quality, lower defaults. It also means is a better net interest margin, and also the reopening trade. You've got millions of people, households, who want to go out and spend on credit cards, and they'll go and spend on the house as well. And so you should get a better credit quality cycle, increase spend. And, you've got a net interest margin improving as well. So you've got effectively 3 huge drivers for the banks, and they're still really cheap. Do you still think, though? But do you still, this, you say improving credit cycle, but it's, with recessions, mostly the biggest amount of failings in the businesses happen coming out of it, don't they? Because right now, a lot of companies in lockdown, furlough, they can tick along. But once they have to open up and start spending, and that furlough drops away, and all the support drops away, is there still a bit of a risk? I think there'll still be a lot of businesses failing in the next couple of months, won't there? But the majority of the people who've got so much money that they just can't spend it, and they're desperately keen to spend it. And so yes, you've got to be careful. You don't want to get sort of single company risk with some big corporate exposure. But I'm pretty sure. I mean, the bread and butter stuff for Lloyds, for instance, is mortgages to households, for instance, and selling credit cards into families. I mean, they haven't got a huge, great, big commercial sort of loan book, etc. Barclays have got a big one. NatWest have even got a bigger one still. But overall, you're getting more than a return just by I mean, Lloyds still trades at 25% to net tangible assets. Anyway, the reason why it was top at the most followed list is because people are starting to recognise is actually this is not going to go to the moon, this kind of stock, but it could easily do another 25% just to get back to net tangible assets. And likewise, the other one, which is again another recovery financial, big cap, which I own, which I've been talking a lot about it in terms of doing a restructuring, and actually the CEO Amanda Blanc is doing a great job. Is Aviva, and the shares have gone from like £2.20 to about £3.60, but they could easily get to net book assets, which is sort of like just south of £5 over the next 12 months because they're selling off subscale overseas operations and going to concentrate on the UK, Ireland, and the Canadian interests. And the idea then is you basically invest and become faster and more innovative into those core areas where you have real scale, and any excess capital which they have, they'll probably do buybacks, and get anything buy back anything less than sort of like net assets. So I mean, all I would say is that those two are steady Eddie big caps that, as long as you have a recovering economy, which frankly I'm sure we will. And the reason, and even if we do get a second or another nasty variant, there's no way the governments are going to not carry on giving stimulus into the economy. We've got so far, we're so deep in there.
But the thing is variants. I was talking to some guy who's medical background on that, and he was saying even with the variants, even if you have these current vaccines, it does still stop critical illness in older people anyway. It may not stop mild illness, but it'll stop the beds filling up. Yeah. So and even then, if it starts, it's mutating slowly. So of course they mutate slowly. So by the time it gets to the point where it's hardly affected, they'll have new vaccines come out to address that anyway. So, but Lloyd's chart is looking quite good actually. I mean, it dropped off the cliff back in March last year, like everything else.
I know.
Came down, and literally it's been going along from 30 pence, pretty much bouncing on there, and then the 200-day moving average, of course, when it dropped off the cliff, the share price went way below that, and then it literally popped above the 200-day moving average, caught up with it in November of last year. See, that's foresight. That's the Pfizer time.
And actually, they've just announced their dividend. They're just paying the highest dividend they can do underneath the regulator. So, as long as you've got a 12-month view, I could see this over 50p. Net tangible assets is I think it's 52.3 or 52.5p. You could easily see it 55p by the end of the year, paying a dividend. Why not?
Well, do you know what? It's struggling. It's in 35 to 40 pence range at the moment, right? And it's tried twice to get above that 40 pence. It's never closed above it since. It hasn't done it since December. And so 2 months is trying to get. I think once it clicks above that, because it's due to. It's looking good for it. Once it gets above that.
Well, I hope so. Anyway, so I've got some money in and Aviva.
Yeah, it literally. I mean, look at it. It's failed 3 times to break that 40 pence and just come back down and retest it. So if it gets above that, the algos will buy into it, and it'll push it back up. I think.
Yeah.
Cool. Good. Anything else? Anything else talking about, Paul?
No, I think we're there actually. We've done all the all my stocks. That's for sure.
You're taking your spreadsheet off there. So you're going through your spreadsheet.
Well, I was just having a look through and just making sure that I was giving investors an update, because I know I only do it sort of once every 2 weeks. But top level, all I would say with investors at the moment, you go through a bit of volatility, but the key thing to remember is the economy is improving. The yield curve is steepening. Long-term interest rates or long-term yields on 10-year treasuries out in the States are increasing simply because people expect the economy to carry on improving. So we're just getting effectively a reset of valuations of stocks that are high growth and more dependent on really rock bottom low interest rates. So this is nothing to worry about longer term.
No, do you know what? I put a poll on Twitter saying market drop opportunity. There's a little drop now. Is there up to? And I just put it a couple of hours ago. 250 votes. 77% of people say yes. No, 23%. The people who are saying no are in cash, right? It's amazing. I see people on Twitter who are very bearish. I know you're in cash.
What's your cash holding at the moment?
Nothing.
Oh yeah, I've got 8%, and that's it now. You're right. We'll have wobbles, but the banks, several banks, and all this
they want the economy to recover. They have to get the economy to
They
recover.
are all
they have to get some
in.
money back. Yeah, they're investing in the economy.
all in.
Yeah, I know they've got to. It's got to go in one way for them. It's got to go one way.
And they've spent so much. I mean, we're talking tens of trillions of dollars. There's no way they're going to jeopardize all that money just by pulling the plug early. They're absolutely just not going to do it.
But you know what? A while back, I thought, why didn't the government invest in the kind of businesses? And I thought, well, in fact, when I talk about that, they are invested in the economy because they get tax receipts, and if they don't get tax receipts, if businesses don't grow and make profits, they don't get tax receipts. So it's, of course, they're all in it, fully invested, and so they can't not see this economy get better. And also just when you look at the drop opportunity kind of thing, the stock market generally goes one way. Every time, I think the guy from Motley Fool said, if you look at it, it's like 1 out of 3 years this has dropped. You can, on a stats kind of thing, but it doesn't happen like that. But you can say, so 2 out of 3 years, pretty much. If you're long, you can do well, And so if you look at the odds are on your side if you're a long-term investor and on the long side.
Yes.
And so you can obviously be bearish all your life. There's people bearish. Or there's a guy who's got so many followers, and all he does is bearish, non-stop bearish, scare people. And I unfollowed him after a while.
Dr. Doom.
Yeah, there's another guy. I thought, mate, you can't, even after it sold off, he was still bearish and it started rallying. I thought, well, you're going to be right now and again, but the majority of the time, you're not going to be right because everyone is creating businesses, want to make more profits. There's help for people from banks and all this government to create, wealth and jobs and all that. So it's all on the one side, pretty much. I mean, you can be bearish now and again, but long term, the market's going up. So well,
I mean, I think you said it so many times. It's sort of like when the facts change, you've got to change your strategy. Exactly. Otherwise, you're going to be King Canute and drown.
Yeah, and I think even now the fact that people are a bit bearish is quite good. That's a positive thing because when everyone's bullish, that's when you worry. But at the moment, there's a couple of bearish people, and the bears are being a bit louder. That's quite good. We have a correction. The correction is good. It lets off a bit of steam, and it can consolidate and carry on. I think it's not a bad thing. Cool. Thanks, Paul. And we'll speak in 2 weekies. And you can catch us on video and on the podcast, of course. But subscribe, hit that notification button if you want the video to your inbox. Speak in 2 weeks, Paul.
Yeah, thanks, Justin. Have a great weekend.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Russ Mould, Investment Director at stockbroker AJ Bell. You're right, Russ?
Good health, and actually looking at some sunshine, a bright yellow shiny disc in the sky, which I've not been seeing much of for the last 5 or 6 months. So do you feel better for that as well?
Yeah, it is. It's funny. The start of this month was so cold, wasn't it? And coming towards the end. In fact, my mother used to say about March, in like a lamb, out like a in like a lion, out like a lamb. But it's happened with Feb, I think, which is nice. But it's nice to have a blue sky, and it seems to almost symbolic. Coming out of the coronavirus lockdown. So we've had announcements, the roadmap out, and we can see the sun coming in the sky. It's almost like, whoever's put the sun up there saying, yes, hallelujah.
There you go. Well, fingers crossed. Yeah, fingers crossed. One of my favourite poems is, one of my favourite lines of poetry is by Philip Larkin. It doesn't quite refer to me now because I'm 51, but that he refers to the unfailing sense of being young, spread out like a spring-woken tree. And I just think it's the most wonderful image, and it always makes me think of it on days like this when you can just feel the heat starting to come through a little bit and see a few leaves appearing. So it's a nice feeling. Long way to continue.
Absolutely. And it's nice
even if I'm not so young anymore.
Yeah, well, exactly. It's nice and you appreciate the contrast. Sometimes, if you go to a country that's always sunny, I always remember someone saying once about a British person, I think it was in LA, said, why do you always talk about the weather? I said, well, because in Britain it's different every day, pretty much. But in LA, it's the same. And it's nice to have that contrast sometimes, between when you come over. But do you know what's changing? And you've mentioned this a while back when there was no sense of inflation. To mention inflation was a bit stupid. You kept saying when people are not mentioning inflation, you've got to be worried about that, when it's off the cards and everything there. And now we're starting to see something happening here. What's going on?
Lo and behold, well, the UK one of my colleagues, Laith Calaf, pointed out yesterday that the UK 10-year gilt yield, so the headline borrowing cost for the British government, is 0.75%, slightly above where it was before the pandemic. Now, if you look, and you're the charts man, and I'll let you draw it when we're chatting. But you look at the 10-year gilt yield back to say 1995, and we're on the verge of breaking a 25, 30-year downtrend in gilt yields. Now, there's been lots of false starts before, don't get me wrong. But you've seen, just in the past week or so, we've seen growth stocks, tech stocks, concept stocks come under a little bit more pressure. I know there's an IPO in the UK today that's gone bananas, but seeing those come under pressure, and it's because bond yields are creeping up, and that's a reflection of inflation expectations. We've talked about shipping costs, we've talked about raw material prices, metals, we've talked about cotton. You can see it in the purchasing managers indices, you can see it in the producer price indices that we're getting from the UK, the US and China. There does seem to be a little bit of inflation bubbling up. Now, again, it could be snuffed out by debt, it could be snuffed out by a very weak economic recovery, it could be snuffed out by demographic. There are lots of things that could, by unemployment, there are lots of things that could snuff it out. But markets at the moment are just a bit windy. Now, why do rising gilt yields or bond yields matter to stocks? Well, there are probably three kind of potential direct implications. The first, if the yield on bonds goes up, income seekers might think, actually, I might stick a bit more money there rather than in equities where my capital risk is greater.
Yeah.
Second, rising interest costs could mean that corporate profits don't go up as much as we think or come under a bit of pressure because corporate debts have gone up an awful lot over the past 5 or 10 years. And if you want me to get really techie with you, the third one is that rising bond yields nudge up the discount rate that analysts use in their discounted cash flow models. So you build a model over, say, 20 or 30 years, putting in assumptions on growth, operating margin, and you add up the profits over the future 30 years, and then discount that rate back at a fixed interest rate to get to a net present value or a current value for the future cash flows. So logically, the lower the discount rate, the higher the equity value, because the more the future cash flows are worth. And so obviously low interest rates or negative interest rates, an absolute boon. But if interest rates go up or bond yields go up, your discount goes up, rate goes up, so your future cash flows are worth less and your share valuation goes down. Now, that's not a big issue if you're a cyclical company, steel, paper, pulp, airlines. But if you're Uber or Lyft or DoorDash or Airbnb or these space travel concept stocks that are being flung at us right now, the vast bulk of their profits are way out in the future. They're very back-end loaded, long-duration assets. And if discount rates go up, they are, in theory, the sort of stocks that start to struggle. So that's why it's particularly important because, doing my job in the media relations department at my employer, I deal with a lot of press inquiries, and I'm still getting far more inquiries about tech stocks and growth stocks and concept stocks than I am about value, cyclicals and recovery stocks. I'm still getting questions about stocks that thrive in low interest rate environments and very little interest in stocks that do really well, historically at least, when there's an economic recovery going on, which is really interesting. So I think those are the three reasons why we do need to pay attention. Now, the counter-argument is, well, look, bond yields are going up because there's a rip-roaring economic recovery coming. So what's your problem? That's going to be really, really good news for corporate profits, and that's got to be good news for share prices. And I have every sympathy with that. But I think there will be, at some stage, a tipping point when even central banks feel obliged to do something if interest rates start going up or the bond yields start really motoring. And there will be a point, I don't know where it is, but lower than the historic peaks, whereby the sheer amount of debt in the system starts to mean that those rising borrowing costs do start to have a negative impact. And, if you just look at the Global Debt Monitor from the Institute of International Finance, which came out, I think, last week or 10 days ago, they said that global debt rose by $24 trillion in 2020 to a record $281 trillion. Now, if we think that, remember the global financial crisis, when it was like, oh my God, how much debt is there in the system? Are you kidding? Well, it was 187 trillion then. So we're 50% higher. Now, the good news is the 10-year gilt yield, looking at the UK as an example, has gone from 5.5% to 0.75% since then. So although the debt burden is so much higher, the low interest costs mean it's kind of manageable. But clearly the problem is if interest rates, bond yields go up, so that means the pressure's on central banks to keep pressing the print button with QE potentially. And that's why, again, people are still looking at, stores of assets like gold and Bitcoin. So there are all sorts of possible implications here. But the big one right now is this is why, if you're wondering why has Tesla come down by a fifth in a month for no particular reason, this is probably the technical explanation as to why.
Yeah, it's funny you say also that, other clients or retail investors are calling you up asking about these high-tech flying stocks. And I always find, and the fear of missing out is the greatest when the market's very high. Like for Bitcoin, for example, all kinds of people who hadn't invested. My father's not a regular investor already. He keeps an eye on stocks. He always has. But he called me up about Bitcoin about 3 weeks back. And I thought, when everyone's shouting about it, the sound is very... when everyone's shouting about it, very loud, that's pretty much the top of the market, because that's when the fear of missing out is the greatest, because everyone's saying, wow, it's rallying. Even the major media outlets are talking about it. BBC News is talking about it. Everyone's talking about it. And the reason why they are is because they're hitting historic highs. That's generally not a good time to get in, is it,
No, and actually, to use that as an example, I was called in by the BBC One Show to explain Bitcoin to a couple of the One Show pensioners.
Wow!
And that
when was that?
Bitcoin. It was when Bitcoin was at $19,000, just before it went straight down to 3.
Yeah, wow.
So that exactly backs up your point, and that's not being rude about the BBC. And in fact, if the One Show pensioners, I think they bought a bit. So if they actually kept it, they'd be fine now. But it was a pretty hairy ride. But it's the old, that I don't know whether it's true or not. There's that old apocryphal story or old story of Joseph P. Kennedy, President John F. Kennedy's dad, who was in a lift in July 1929, and the bellhop was giving him stock tips. And John F. Kennedy got out of the lift and basically sold his entire share portfolio in July 1929. 3 months ahead of the Wall Street crash.
Well, do you know what's funny? I'm really
curious. The view, look, if the bellhop's in the market,
everyone's bought.
Who's left? Who's going to be buying from the bellhop? No disrespect to bellhops, but they're not top of the economic pecking order. They're quite near the bottom. And if they're in, then who's going to be left to buy after? And that was his. That's the story anyway. Yeah.
Well, you know, my friends from the Weekend Podcast make fun of me because I often mention the shoeshine guy, and I think it was a Hoover. Again, I don't know which one's apocryphal or which one's true. I have no idea. But again, if everyone's on one side of the boat, it can tip over.
The boat's going to tip over, right? And I think, look, I suddenly sent you a thing yesterday about an ETF that's for space commodity mining and producing commodities in space. Okay, fine. I mean, these are the sort of things, the concepts that can fly. And when we reach this stage of the market cycle, things can get hot and sweaty for a lot longer than you think. But, the more risk you take, then potentially, clearly, the greater risk there is for an accident. If you ride a bike slowly down the street I'm looking at right now, with your helmet on, keeping your eyes peeled, touch wood, you're going to be okay. But if you get on a motorbike and take your crash helmet off and go down, put your foot down and close both eyes, then the chances are massively increased. You're going to get a bigger thrill, but there could be a nasty poke at the end. Yeah. And it's the same with stocks. The more risk you take, yes, there are potentially high rewards, but you are substantially increasing your chances of an accident. And the more people who are getting frightened of missing out and piling in, not because they like it or understand it, but just because they can see it going up, it's not normally a healthy sign. No, it doesn't mean things can't keep running. And you've got this thing, is it CBX in the UK today?
CBX, I mean, I saw it.
That's gone up through the roof. I mean, again...
cellular goods. Do you know what?
That's the one.
Yeah, I've seen it on social media a lot, and it's a lot of these CBD sort of cannabinoid stocks at the moment being listed in the UK. And I don't know how it seems to me that I don't know how sort of competitive the market is, but it seems at the moment there's a lot of people coming online very soon looking for lots of money.
I think if you in Canada, I think in Canada, if you've got some intellectual property and you're on the healthcare side of things, I think that's there is something there. There's a potential competitive advantage.
Yeah.
If you're just growing the stuff, and I haven't looked at CBX, but if you're just growing the stuff. Well, it's called weed for a reason, isn't it? It can't be that hard to grow. And,
I think this company do sort of what do they call sort of celluloid sort of is closed based on they do the consumer products, premium consumer products based on biosynthetic cannabinoids. So I talked to another one this week actually about, and they do medicinal cannabis and it's through a vape sort of thing. It's a big market. I'm just worried people are jumping on these bandwagons and going crazy, and I'm thinking,
well, you saw
calm down a little bit.
And it all went up in a puff of smoke, if you'll pardon the expression. I know it's bouncing back now, but again, I think you've got to make sure that these companies have got a real competitive edge, because there could be a lot of copycat and imitators. And in the end, although we're talking about bond yields going up, money's still really, really cheap. So getting your hands on it and chucking supply at something isn't terribly hard, which is a counter-argument, actually, to the inflation argument, of course. You can just conjure supply. But I think in that respect, certainly with something like cannabis, where it clearly isn't terribly hard to grow and could at some stage become much more tightly regulated for certain reasons, then there are some potential challenges there. But yeah, I think when you start seeing one sector with lots and lots of IPOs in it, and the imitators and the copycats start crawling out of the woodwork, it's normally time to be really, really, really careful and circle the wagons.
Absolutely marvellous stuff. Cheers for that, Russ, and we'll speak next week.
Keep well.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Vadim Alexandre, Head of Healthcare at SP Angel. You right, Vadim?
How you doing, Justin?
I'm all right. Yeah. Well, do you know what? It's I had my vaccination, but was it week before last? I think it was. And when sort of carers were allowed, so I'm officially known as a carer because my son's got a lung condition. He's vulnerable, but. I felt rough as anything next 2 days, really did. And I thought, COVID can't be this bad, surely, because I'm not unhealthy. I don't think it would affect me that badly. But my wife is also very rough. And I was just thinking, how do the older people cope with this? I mean, are there stats out there that say that actually the vaccine has made older people very ill? But I didn't expect it. I didn't feel the actual jab itself. Very good. Went in quickly, done. Didn't feel the jab hardly at all. But then a day after, I wasn't feeling the best at all. But there we are. I'm not looking forward to the second one. Go on.
So apparently, people who have had COVID are seeing more side effects associated with the first vaccine. So it's possible. Have you ever had an antibody test done?
No. Yes, we have. No, we had antigen, I think, test. We haven't done quite regularly. Yeah, but okay. So I may have had it. You think?
Yeah, well, it may also just be the first jab. Also, there's side effects, but it's particularly those who have had it before who have the first jab afterwards. They react aggressively to it, which makes sense, right? This is like a booster. It effectively becomes like a booster. So it's possible you've had it. Yeah,
okay, maybe, who knows, but it didn't feel that comfortable at all, nice and easy. But there we are, marvellous stuff. Okay, let's move on, let's not talk about COVID now, we've been doing a lot of coverage on that and testing stocks. News out, what's the news? Any companies there with news out?
I think today there was an announcement by Shield Therapeutics. Shield, is that their? Yeah, Shield, anyways, they have effectively a different way of delivering iron for anemia. They did a pretty steep discounted placing. I think it was done at 30p, and the prevailing stock price was like 50p. And it's bouncing back a little bit. But this is a company that's had ups and downs and a bit of history, a bit of a difficult history. But at these levels, it just seems like good value. That's kind of, I think, the message for that one for today.
I've had him on the podcast there, and do you know what? One of the best times to, if you like a company and you've been watching it and then you've forgotten about it or something, and then you see the placing it's dropped. It's one of the best times to invest because you may get a bit of volatility because you may see some quick flippers, a bit of trading going on there. But give it a little while, and of course, now the company's got cash, then it's all good, isn't it? All good to go because that's it. De-risk.
Exactly. That's why I'm flagging it today. Look, this is one I might take. I haven't decided yet. I'm just depending on it's exactly that. It's always difficult to get the timing, but post a raise, that's when the company is in its strongest position. So they've raised £25 million. There's a bit of an open offer there, so they might get some more. On a market cap of, when you calculate the discounted value at 30p, on a market cap of about 35 million pounds, right? So it is extremely dilutive to existing shareholders. But my point is, new shareholders coming in they're in a very strong position because the company is cashed up completely, and they want to use this money to I think go it alone and launch their product in the U.S., which is all, this is a pretty advanced stage company. They have a product now, and they've seen highs of 150, 160p, in the past, and this placing was done at 30p. So that's why I think, it might be good value. Now, you're right. Timing of the purchase is always the difficult part, right? So if you haven't participated in the placing, like me, I haven't participated in the placing, but, stock price is now hovering around 40, 45p. So it's quite a big uplift on the placing price. And I think I calculated roughly that puts it on a market cap of about post-issuance, right? Because the shares, because they haven't been issued yet, of about 70, 75. So yeah, if it bounces much more, it starts to become less attractive. It's not as deep a discount anymore. But that said, you put your finger on it. Once the shares get issued, which is, I think this one's going to general meeting. So once the shares get issued, there's always some trading that goes on, and there's a bit of there might be an opportunity to get them somewhere in the mix. So from now until, I would say, 2 weeks past the issuance of the shares is the time to be looking for dips if you want to buy these shares.
Yeah, marvelous stuff. Cool. Right, and you're going to mention Diurnal. What's happening there?
Yeah, so Diurnal, I've flagged it in the past. It's one I own. It's a company I like a lot. It's another company, generally speaking, that's good value because they have a product on the market, and admittedly, that product has had some trouble in terms of sales. I mean, we're talking about a small product, so it's not like we're only talking about 1 to 2 million in revenues. But it's one of these companies that is post-COVID. I think will benefit from the the kind of the unlocking of all of these European markets. So their initial product Alkindi, I think, will start to take off again. So we'll see a bit of an echo post-COVID. But most importantly is they're waiting for an approval from the European the EMA, the European regulator, for their second product, which is Chronocort, which is expected this quarter. It's imminent. So in the next 6 weeks, we expect to have an answer. That's the one that's it would be. Obviously, if they don't get it, that's bad news. So it is a bit of a binary outcome here in the sense that, there's a punt that one has to take. But, if it goes down, it would go down, I think, 50% on that news. But if it goes up, it could go up multiple fold because the market for their second product, Chronocort, is in Europe, it's something like $300 million market. At which they'd make probably about 80% margin on. Now, they're not going to get the full 300 million overnight, but even if you calculate 10 to 20% market penetration at 80% gross margin, you can see why there's a lot of value in this announcement. So they're waiting on a European approval. It's scheduled to come in Q1, which leaves us a month and a half, just over a month of waiting time. It could happen any day.
Okay, cool, marvelous stuff. There's another chart there. What's the ticker there? What, DNL, is it? Diurnal?
Yeah, DNL. That's right.
Oh, and
just remember, this is a risky play, right? In the sense that, buying right before an announcement, you could see it could go the wrong way, right?
Yeah.
But the balance of probability is that it should go the right way because they've had a correspondence with the regulator. The regulator encouraged them to submit. And it is for an orphan indication where there is a need, there's a real need. So, but it's true. And we have seen it time and time again. We have seen it before. This could go the wrong way. But my bet and the one I'm taking is it's going to go the right way. And if it does, it could have a significant uplift. And certainly it should, is what I mean, in that, they would have a big market to go after. And they don't need to get all of it. They don't even need to get, at 20% penetration of a $300 million market, you're talking $60 million in revenues potentially over the coming years. And if at 80% gross margin, that tells you what the valuation should be, right? Mm-hmm. So that's just back of envelope, let's say we got to 50 million in revenues out of a $300 million market. And you could argue they could get up to 50% of that market because it's an orphan indication, okay? So usually in these indications, it's because the need is so high that you probably get pretty big uptake of the product. But even if you took, say, 50 million, let's say it's a $50 million product, making it a $40 million gross margin product, that goes straight through the bottom line for this company. Mm-hmm. You know what I mean? Effectively. So you take an uplift, I don't know, 5, 6, 7 times of that. I don't know what the multiple you want to pick. Take 5 times multiple. That's a $200 million valuation for this product on this market. So you can see why I'm saying that. The current market cap of the business is 85, I think, million sterling. Call it roughly 100 plus. You can see a multiple of the current valuation on this product alone. In Europe alone, by the way. Then there's all the other, global markets that they can go after one at a time. Obviously, they have to get regulatory approval. But the beauty of this company is they've done it all for their first product, Alkindi. And they would be, just replicating that same distribution, that same regulatory approval kind of sequence of events with all the other markets. The U.S. is different because the U.S. requires different data. So that would be, that's carved out separately. But post Europe, it would be other markets, which it's a well-trodden path for this company. So again, binary outcome a little bit. Binary definitely skewed binary upwards, as in on a positive, just approval. Could happen that you get a negative result there. So bear that in mind. But on the upside, if it comes through positively, which it should, and I hope it does, because I'm a holder. So if it all goes in the right way, then I can see a lot of upside to this business.
Yeah. So back in July, when it doubled, what was that announcement? It was, I'm looking back. What was that? Price monitoring extension. Positive detest. Okay, regulatory meeting with the US FDA. Okay, so it went from 30 pence there back in July to 60 pence pretty much in 2 sessions, and they came back a little bit to like 45, and it grinded back up to 70, and it's been going sideways pretty much and down to 60. But who knows? It'll be interesting to see. Cool.
People have been waiting. This is the announcement that I think the market's waiting for. So it's imminent. So that's why I'm flagging it today.
Marvellous stuff. Cheers, Vadim, and we'll speak you next weeky.
Excellent. Thanks, Justin. Speak soon.
Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5. Bear with me. Suspense. Just got on the wrong page, is all. At 5, it is Canabo Group. Of course, I talked about those on the podcast. Down 11% today. In fact, I talked with the guys yesterday. It's Cannabinoid Group, of course, down 11%, 27.5. At 4, My Health Check, up 3% to 3.4. At 2, Shield Therapeutics, 53 pence there. At 2, Fragrant Prosperity Holdings, up 6%, 6.62. And at 1, Cellular Goods. First day of dealings done very well, so I think it doubled in price. I don't know where it is now. I think it's come back down a bit, but CBX is the ticker. First day. And he's talking about cannabinoid stocks, of course. We do mention that actually on with Russ Mould today, and whether that market is overcrowded or overheating or whatever, because it was very hot a couple of years ago in Canada and in America, and now it's come over here, of course. But yeah, lots of cannabinoid stocks out there at the moment. Lots to choose from. Also, let's look at the top 5 most read RNSs today. They are at 5, Vasarin, Innovate UK Loan. At 4, Cellular Goods, first day of dealings. Wow, that's a very popular first day there. Got a lot of people reading that for a new company RNS. That's amazing. At 3, Tizion Life Sciences, interview to A on Bloomberg. At 2, 4D Pharma, US SEC declares registration statement effective. And at 1, Argo Blockchain, installation of 4,500 new mining machines. That's it for the podcast. Thanks for listening. Muchos appreciated.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.